Welcome back to Pro News. As geopolitics dominate the headlines, there has been a lot going on in the markets lately. Let's dive into the currency scene. US producer prices have been climbing faster than anticipated, putting renewed focus on price acceleration for investors. The headline PPI shot up by 0.5% month-on-month, outpacing the projected 0.3%. And year-on-year, we've got a jump of 2.2% versus the expected 1.6%. This shift in annual rates is due to revised data from earlier months. Breaking it down, this simply means inflation on the producer front is hotter than initially gauged. Following a strong run from the dollar, the euro took over the spotlight for a while. Euro-dollar was on an upward journey from early October, helped by softer-than-expected hourly earnings the previous Friday. However, the US dollar then caught a fresh bid against its major peers, recovering ground after the headline US CPI on Thursday delivered a slight upside surprise. The annual CPI rose 3.7% in September, beating expectations of a 3.6% increase. Once again, we witness another twist in the higher-for-longer narrative. Stay alert, the currency tug-of-war is still in motion. Kicking off the week, geopolitics gave gold a boost, causing it to open with an upward gap. However, this recent uptick might be more of an instinctive response to current events rather than a prolonged upward trend. Given this, it won't be surprising to see some short-term profit-taking soon, giving the bears a nod. Yet, gold seems to be putting up a fight after shedding 3% the week before it made a comeback, touching $1,919 at one point on Friday. While there might be an attempt to push gold below the $1,810 mark in the days ahead, there's still a chance that these levels will start appealing to long-term investors, hinting at another gradual ascent on the horizon. Gold's journey remains an intriguing one to watch. What's been happening with the major US indices? Well, they've pulled off a noteworthy comeback last week and have been on a solid upswing since. What's driving this? A shift in the Fed's tone. Over the past week, FOMC members have been dropping hints suggesting that we might not need further policy tightening. Quite the game changer, right? This pivot from policymakers seems to be a reaction to the swift climb in the long-term bond yields. And here's where it gets interesting. This kind of change in the Fed's stance is a bit new. Since 2007, such shifts were typically triggered by hiccups in the stock market, not the bond market. As for the market's predictions, well, now there's a 27% likelihood of an interest rate hike this year, a drop from last week's 47%. From the technical analysis perspective, we observed a notable reversal shortly after touching the 200-day moving average. It's common for this line to act as resistance or support, but it seldom functions so precisely. Will the bears dare to try again? Stay tuned, the financial landscape is always evolving. Moving on to crude oil, we saw a rebound in oil prices, likely a move to correct its short-term oversold state. But this might just be sparking interest among potential sellers. From a technical standpoint, this recent bounce is seen as a vital correction that could pave the way for an impending drop. Brent oil took a downward turn from the $95 mark, rapidly plunging to $83 and breaking through the 50-day moving average. By last Wednesday, it became clear that the bears were taking charge. Interestingly, the RSI on daily charts hinted at an oversold territory. Since the close of 2020, such signals have consistently marked a trend reversal, and we saw a similar pattern this time. With a strong move on Friday, Brent crude hit $89 at one point, so the technical analysis worked fine this time. But no one can surely predict what is around the corner of Middle East geopolitics. We must stay prepared for everything. If the bearish momentum continues, the next significant support seems to be the 200-day moving average, hovering just below the $82 mark. For those with a broader perspective, a downside target of $75 looks possible. By year's end, this could coincide with the crucial 200-week average and the 161.8% level of the last decline. The oil saga continues, so keep your eyes peeled. Let's dive into the crypto world. Despite the optimistic vibes in traditional finance, the crypto market has been taking a hit. Bitcoin dipped under 27K during Wednesday's early trades, marking its 5th straight day in the red. This comes after Bitcoin couldn't manage to firmly stand above its 200-day moving average the previous week, and it became a starting point to sell. Now Bitcoin is hovering just below the bottom line of its upward channel, finding temporary support at 50-day moving average, but it still has a chance. If it manages to bounce from this point, it could signal the start of an upward trend. And a quick shout out to Ethereum and Litecoin. Both took hits, with Litecoin even edging closer to their lowest point this year. Looks like the crypto winter is not in the mood to end. Alright, here's what's on the radar for the upcoming week. On Tuesday, be on the lookout for US retail sales at 12:30 GMT. Fast forward to Wednesday and we've got a busy day with China's industrial production at 2, the UK's CPI at 6, and rounding off with US crude oil inventories at 2:30. As the week wraps up, Friday brings us the UK retail sales bright and early at 6. And don't forget, it's earnings season. Big names like Tesla and Netflix, along with some major banks, are set to share their financials. Stay tuned. Keep trading like pros, and we'll be back with another market news update next week.